Save your questions to the end. I'll be very happy to stand up here and answer your questions at that time. And I myself came to Israel almost 40 years ago, 38 years ago. My first office was not far from here on Shtei Herzl in Beit Kerem. So I don't even think there was a Givat Shaul, and there certainly wasn't this place. There certainly wasn't a Har Nof. And time flies, Israel develops, and this is part of that development, the tax rules. As you may or may not know, before 2003, Israel didn't tax income that was earned outside of Israel. That reform took place in 2002, and this is sort of the next evolution of that, what we're going to talk to. So I think the headline speaks for itself, what you need to know and what you need to do if your 10-year exemption is expiring. Again, this is 217, but it could be for 218, 219, and beyond. So, first of all, what you should have been doing up and down, and of course I'm addressing the issues that we're going to be addressing tonight are people who are also U.S. citizens. So even before this, whether you were obligated, hayab, not obligated before, from declaring anything to the state of Israel, you did have obligations because you lived outside of the United States to the United States. One of that is reporting the fact that you have foreign bank accounts, at least a foreign bank account or a combination of accounts that any time during the year had more than $10,000. You probably have all been contacted by your bank in the last couple of years to identify yourself as an American, to sign a W-9. If you haven't been contacted by them, you don't have to go to the bank. It's their obligation to contact you, but you should have been declaring your foreign bank accounts. There's a form called an F-bar. It has to be filed electronically, and it's a very simple form. It just says the name of the bank, the name of the account, the address of the branch, and what was your highest balance during the year. If you owned a company, an Israeli company, that's what I'm referring to, a foreign corporation, and you were the majority owner or had a significant portion and there were other Americans, you had to disclose the existence of that corporation. And of course, if you worked here, or you had money here that was earning money, or you had rental income, you were supposed to tell the United States government about it as well. In other words, the United States does tax their citizens on their worldwide income, and those are all things that you should have been telling them about. If you haven't done any of these three things, there are ways of catching up, getting back in the system. The most popular form of that today is called the Streamline program, which came, I think, into effect a little over 3 years ago to allow people who didn't know, who didn't willfully not file, to get back in the system, and it can apply to any one of those three or all three. So what remains the same after your 10 years are up? Your Social Security, if those are people here, I have a very young crowd here, so probably none of you get Social Security. You do. Okay, and except one guy here gets Social Security. That is not affected by the 10-year exemption.
You're talking about being what's taxable in the U.S. versus what's taxable here?
Gam bagam. Okay? Gam, U.S. and also Israel. In other words, under the treaty, your Social Security is not taxable even after the 10 years are up.
Just want to quick, are you going to, do we have to write anything down, or are you going to be giving us a link to this presentation?
I don't know. We'll probably figure something out.
But it's
Okay.
not taxable both in Israel and in the
Correct.
States?
That's right.
That is correct. Okay. There's a little history lesson there, which I don't have to go into, but the original treaty, the U.S.-Israel tax treaty, was first. The negotiations were started in 1975. In those days, no one paid tax on Social Security in the United States. It took them 20 years to ratify the treaty. By then, Social Security was taxable. They didn't want to reopen sections that had already agreed on, so it's really an unusual provision, and it's a gift to U.S. citizens living in Israel. But that is it. You weren't paying tax up until now in the U.S. You're not going to pay, and you're not going to pay to Israel. If you have income in the U.S., it's of course still taxable. It doesn't change the fact that you're suddenly taxable here. You may be getting credits, and I'll talk to you about that a little later. And the other thing is there is no double taxation. The U.S., there's been a treaty for the last 22 years between the U.S. and Israel, and that prevents, if you pay here, then you get a credit there. Or if you pay there, you get a credit here, so you won't pay double taxation even though your 10 years are up. What does change after the 10 years? So, as I said a moment ago, what I would call, let's call it who gets the first bite. In other words, if you say, well, I earned dividends from Ford Motor Company in the U.S. Who do I pay? Well, if it's a dividend from a U.S. company, you'll pay Uncle Sam first, and then you'll get a credit against your Israeli tax. And if you have income here in Israel, that now you're going to start paying tax, you'll get a credit there. And there are certain things that go against logic. For example, if you have interest in the U.S., Israel will get the first bite, so the U.S. will give you a credit, and if you have capital gains from securities, from stocks, the U.S. also will allow Israel to tax that income first. So you'll have to start paying first Israel and then get a credit in the U.S. The treaty, and I'm not referring to the president, okay? In fact, when I originally gave this speech, he was not yet president. But the treaty trumps tax laws. In other words, there are things in the treaty that actually can override domestic law, both in Israel and the U.S. And you'll always pay the highest tax, meaning that if you start paying Israeli tax on your U.S. investment income, which in Israel they charge you a flat 25%, whether it be interest, dividends, capital gains, short or long term. But let's say in the U.S. you're only paying 10% or 15%. So you're going to now pay 25. You may give 15 to Uncle Sam, but you'll have to give another 10 to Israel. So you're always going to rise. Your effective tax bracket is going to go to the highest tax in whatever jurisdiction or jurisdictions you're subject to
But
tax.
you get credit.
You get credit, but you're going to pay the higher. You're not paying double, as I said. You're going to pay the higher. Okay, so as I referred to before, who gets the first bite? Interest income, this may be one of the more important notes for you to be taking. Israel gets the first bite. Capital gains. Israel gets the first bite, and that's capital gains from stocks, not real estate. Okay? And U.S. dividend, the U.S. gets the first bite.
So are you saying on an American capital gain,
Yes.
Israel takes
From
the
a
first
security. From security.
Right, on American capital gain on the security, Israel gets the first bite.
That is correct. Now,
And same with American interest.
yes. Now,
And if it's Israeli interest or Israeli capital gain,
then Israel gets the first bite also. Now, there's more complications because if you have a stock that you've been holding 10 years, or let's make it easier. Let's say you've been holding you've been owning it 10 years, and 9 or 8 of those, let's say 8 of those were in a period where you were under your 10-year exemption. Israel won't tax you on the whole capital gain. They'll only say, we can only tax you on 2/10 of that gain. And if our rate is if you're only paying us 20% and our rate is 25%, we can only tax you 5%. So you'll pay that 5% to Israel, and then you'll pay the difference. So if people have stock portfolios where they invest and hold a long time, even beyond the 10 years, you're not going to feel this tax. Is that clear?
are the Israeli taxes that we pay deductible on our American tax return?
I'm sorry, what?
Are the Israeli taxes that we pay deductible on the American return?
They're creditable. In other words, you'll get a credit.
No, but I mean, that credit just equalizes things, right?
Not always.
Depends what.
Okay,
it doesn't come
sometimes
back to
Israel's
deduction.
more than the U.S. would charge you on that same income. So you have odafim, you have excess credits. In other words, but you're allowed. There's baskets, and whoever prepares your return will keep track of those foreign tax credits. Yes.
Is there such a thing that with that 10 years, there was also if you bring dollars into Israel and put it on interest, you have another 10 years, you don't have to pay any interest? Is there 20 years including in that 10 years?
There certainly was a provision several years after. I think maybe in 2010 they came up that
2008, they also had it.
if you brought the money to Israel within, I think, 90 days, you could.
No, they said up to the 9 years, up to the very end. bring it
I'll
up-
tell you the truth, it's been so irrelevant because there's been no interest paid.
That's true.
So no one was really bringing money to put in Israeli savings accounts, but there was something that they allowed, and I've seen very few people take advantage of it. As opposed to leave your money abroad for 10 years, you could bring it here within the first 90 days. But I'm not aware it may exist, but again, the benefit is going to be minuscule because the interests have been almost zero here in Israel. Again, continuing on the first bite, if you have U.S. rental income, the U.S. will tax you first. If you have pensions, even though if they're from the U.S., this is a bit complicated. I'll touch upon this in a few minutes. Israel is entitled to the first bite, but I'll explain in a moment. If you're a consultant, if you get consulting income, even from a U.S. Entity, Israel will get the first bite. Okay, so here's what I want to talk about pensions for a moment, and that can be anywhere from pensions from a private company to 401ks to IRAs or any other form that you may have. There was a history here in 2002 that I referred to a few minutes ago when they were amending the Israeli tax code to have anyone living in Israel pay tax on their worldwide income. They put in we formed a lobby group before there was Nefesh B'Nefesh. I think, well, they still exist, ACI, and a bunch of us got together and we raised some money and we hired a lobbyist and we tried to soften the impact of that change on Olim, who were particularly pensioners, okay, because today's Sunday, it's NFL in the U.S., so we felt it was like going in at halftime into the locker room and then coming out and they changed the rules on you. And so they actually came up with, we were able to lobby for a provision that gave special tax calculation on anyone who has a pension from abroad, who came as an oleh once upon a time, and if I summarize it, you are tax neutral, and what I refer to as special tax calculation. In other words, Israel says your 10 years are up. According to the treaty, we get the first bite. But here's how we're going to tax you. We're going to say to you, go to your accountant. Let's use an example. You get a $20,000 withdrawal from your IRA. Prepare a tax return, a U.S. tax return with just $20,000 on it. That's the only income that you earn. Well, $20,000 less your standard deduction, 2 exemptions for a married couple. Maybe there's only $2,000, $3,000 of taxable income. The tax on that would be $300. Israel says, pay us the $300. The U.S. will give you a credit. So it's just, think of a pie. Before the U.S. was getting all the pie, now Israel's going to get a slice, but the pie didn't get any bigger. So anyone who's on pension, who's gone beyond the 10-year, you have nothing to worry about. You're just going to be enriching the Israeli treasury, as they say, al khashbon the U.S. treasury. Is that clear?
No.
You gave
No.
full exemptions and deductions to that calculation.
You prepare like a fake tax
I
return,
understand
only
what you're
showing that pension income. And you
With
come
full
up-
exemptions
full
and deductions.
exemptions, full standard deduction, okay?
Okay.
As if it was your only income,
Just
okay?
like- okay.
And so it's, again, it just means you're going to have to pay something, or maybe you'll have nothing to pay to Israel. But at the end of the day, if you take your left pocket and your right pocket and your left pocket, you will not pay more money on your pension.
Does that include both 401k
Yes, yes.
and pension and 403b?
Yes.
All that stuff.
I mean, again, if I go back to a little history, one of the final things in our negotiation with the Mas Haknasan, the Treasury, was they would provide a list of all the types of pension, what you call deferred compensation, deferred retirement. They would provide a list from all the countries. Have you seen that list?
No.
Okay, so nor have I, and that was 15 years ago, so I don't think that list. So, but having filed returns under this regime for the last 14 years with my Israeli counterparts, they accept this. This is a methodology they accept, whether it's an IRA, 403B, blah, blah, blah. Yes.
If you do have,
Standard mode for withdrawing from,
I'm sorry, what?
the standard mode for withdrawing from pensions normally obligates the issuer of the pension to deduct 20% flat rate, which goes into the Fed. So one presumably has to then recover it. And
That's correct, right. But you can, I know if you have a foreign address, they make you withhold 10% at least. But sometimes you can counter that. You can fill out a W-4, I think, P or something like that, and you can ask for reduced holding. But worst case, you will get, that withholding is not the amount that you take as a credit. It's just a withholding that you can recover or apply against other income. Yeah.
you said as if it's your only income. So if you also have, let's say, consulting income plus pension income, you apply this special calculation for the pension income portion and then do
No,
the
you
other?
just come up with a U.S. tax on that pension income as if that was your only income.
And then
And that's what Israel's entitled to.
for the pension, but then you do the rest of your income separately.
Correct.
In like two different filings.
That's correct. It's not two different filings because that
'Cause it
fake
doesn't get
return
filed.
never gets filed. It's just something that we keep in our files. We show it to the Israeli accountant, and so he
But
knows
I
how
just
much.
want to say, so you use the pension calculations you described it on that portion, the
Yes.
20,000,
Yes.
and then you calculate your tax on your other income
Under normal rates.
normal rates, and then you
Correct.
pay the
Right.
sum, or the sum is
Correct.
due to Israel.
Correct.
Is there a difference between a Roth IRA or in a traditional
Yeah, sure.
IRA
Roth
in terms of the
IRAs,
income?
Roth IRAs are not taxable.
Right.
So if
But-
someone has the privilege of owning a Roth IRA, so if I filed that fake return,
Mhm.
your tax would be zero on it. If the tax is zero on it, Israel gets nothing. So your Roths are very beneficial in this.
One more time, on this fake return, this is for the Israeli government, right?
It's ultimately it's basically to back up the calculation as to what tax the Israeli
Okay,
government would get.
I have a pension,
Yes,
okay, totally taxable in the US.
right,
And I've been paying it every year.
right,
Okay, so now you're telling me that this pension,
yes.
I take the full amount of the pension, and I make a fake return.
Yes.
And where do I pay my taxes?
Whatever comes, the result that comes on that, I'm sorry, I know Trump uses fake news, so I'm calling it fake return. Whatever that tax calculation comes out to be,
Okay.
you take that sum and you write a check to Mas Haknasa. And then Sam says, we'll give you a credit for that.
Who?
Uncle Sam, IRS.
So I will not be double taxed?
No, no.
Right.
You pay the
So
same.
what if among, besides the pension, I have,
Yeah, that's what the other gentleman said.
401k.
Then when you do your Israeli tax return, you follow the regular rates, which will go
So
into.
you're only talking about pensioning?
Yes, but for people in this crowd, I think it's a relevant topic.
No, it's relevant to me.
Right, okay,
Is
so,
the rate that's calculated on the pension an Israeli rate or the US rate?
no, it's a US rate.
Okay, so Israel uses the US rates but gets the,
Yeah.
That was,
he gets-
that was the fruits of our labors from that lobbying effort. So I'm giving you personal history as to how this evolved, yeah?
Is this pension payment part of the tax filing in
Yeah, sure,
Israel?
sure.
Or is just
It's a
a separate
think
payment?
of your
Is
Israeli
this a
tax.
separate
Think of your
payment?
your Israeli tax return. And there are different categories. There's interest, there's dividends, there's capital gains, there's rental income, and then you have a category called pensions. On that, the tax is unique. It's not a flat
I
rate.
understand
It's not
that,
according
but-
to the tax tables.
But-
It's a special,
I
and
am-
it
But I'm not
works.
paying that separately and then
No,
filing
no,
another?
no.
Okay.
It's part of your return. Okay. One more, and then I want to keep going. Yes.
If you were to file that hypothetical return
Yeah.
in the U.S., you would be entitled to a tax credit for
No,
any
no.
taxes
But you
paid.
can't.
You can't
But you can't. You
So
can't.
it's not a loop.
No, you can't do
No,
that.
they take the first bite.
Yes, did you have a woman in the back? Yeah?
Yeah, I happen to be a Canadian, and my understanding was that, thank you, Yossi, that the Canadian government and the Israeli government had this tax thing at 17%, right? So every year.
I know nothing about Canadian tax.
Well, okay, then I won't go on.
Okay, sorry.
Excuse me, when you said the U.S. gets the first bite on rental income, does that,
On U.S. rental.
on U.S. rental, does that also apply to S Corp and similar type of income? Are you
Yeah, sure.
giving the broad?
Yeah.
Okay.
Okay, here, that's a good segue. Real estate, in other words, Israel will give you a credit not only for federal taxes, but state taxes as well. So if you have rental property in a state that has a tax, even though that's not part of the treaty talks about credits for income taxes. Israel, back in the early 2000s, was magnanimous and said, we'll also give, if you're paying state tax on income that's U.S. source, we'll give you a credit on the state tax as well. So I had a conversation a few hours ago. Someone had a property in the U.S. They're paying 15% federal tax and 7% approximately to the state of New York. So that's 22%. If Israel's only taxing you 25% on that gain, you only have to pay Israel 3%. You pay 22 to Uncle Sam. Israel also, as part of the tax reform, this is also going back, if you have rental income in the U.S., they give you two choices on how to be taxed in Israel on that income. Either you can be taxed on your net, meaning your gross rent, less all your deductions, depreciation. There's some machloket and controversy. Will they accept U.S. depreciation, or do you have to use Israeli depreciation? You figure your U.S. tax, as I said, they'll give you a credit, and then you pay the difference. Or they say, we'll charge you a flat 15% on your rental income, less depreciation, period. We won't give you a credit for any of the taxes you pay in the U.S. So it's something that you have that flexibility. You can make that choice, and your Israeli accountant can look and decide what's best for you.
If that's the case, then the U.S. has to accept it, that you pay the Israeli.
No, they don't. The U.S. is out of it. The U.S. is saying, we get it because this is U.S. real estate. We get the first bite.
Okay.
Now you have to deal with Israel. So Israel says, we'll give you two choices. Either you report on the same basis as you did on the States, and we'll give you credit, or you can just report on gross rental, less depreciation, and we will just charge you a flat 15%, but we won't give you credit for those taxes.
But it's more money out of your pocket.
It depends. It depends. If you are in a deal where you get a triple net lease, it may pay to do that as opposed to the first one. So, okay. If you're working still in the U.S., if you're working for a U.S. employer, meaning you're doing some of the work there, you're doing some of the work here, in terms of who gets the first bite, for the days you work there, Uncle Sam will get the first bite. For the days you're working here, Israel will get the first bite, which means that if you've been under some arrangement where you haven't been paying tax, or you're paying a reduced tax, then you should adjust your withholding. A quick mention here, again, there was a case about a year and a half ago. Some fellow from Ra'anana was working for Merrill Lynch. He wasn't really allowed to work here. He periodically went into the U.S. to see his clients. The IRS audited him. He actually defended himself in court, which is probably, you should never defend yourself in court. He lost the case, and basically the IRS said he couldn't exclude his income for his days in Israel because his employer didn't require him to be here. It's just a little side point. All I'm saying is if you're still working for a U.S. employer, you really have to sit down if your exemption is about to expire and make some adjustments as to how much tax you're going to be paying. If you're an Israeli employer, there's some different rules, and that's based on the treaty, that if you say, well, I'm working for someone in Israel, and now I'm going to the States, does that mean the U.S. gets to tax me? Well, if you work for an Israeli employer and you're in the States less than 183 days a year, the U.S. does not have, Israel gets the first bite even on your U.S. days. Israeli rates, as you know, are higher than the U.S. We'll see them a little later. But your wages from an Israeli employer are never subject to Social Security or FICA. If you're a consultant, Same rule about the 183 days. If you have your own business, you can go to the States. If you were there less than 183 days, you don't have, Israel gets the first bite and the U.S. will give you a credit. There is a big problem for people who are self-employed here in Israel, where you're subject to both Bitul Humi and Social Security. There's been some recent rulings, if you operate through an LLC in the U.S., that you don't have to pay Bitul Humi. This is sort of a new planning technique that I see a lot of people using, particularly those people whose 10-year exemption is expiring. And then you have to also just check, are you really an independent consultant? Maybe the U.S. views you as an employee, and you have to be careful that you're not running afoul, you know?
U.S. has some rules about offshore income if it's not where you're residing. So in other words, I'm an American citizen, I live here, I do some consulting in another country.
Yes.
So
It's where you perform the service. In other words, if you're sitting in your study, your living room, your basement, or renting an office and you're consulting with customers in the U.S., then it's considered foreign source income.
Then it's Israeli. Then
It's
I'm in Israel.
Israeli source,
But
correct.
my point is, under this circumstances, and I do, let's say, a month of working in Korea,
Right.
okay? So the U.S. treats it as at like, I think, a 10% rule or something like this, where it's not even taxable as your resident, because you're no longer, if it's
Right.
Israel.
They'll view your Korean income, your UK income, your German income, and your Israeli as one basket of foreign source income, where basically if you're paying Israeli tax, any Israeli tax you pay on the Korean or the German or the UK, Israel gets the first bite, and then the U.S. will have
So
to.
Israel will
do
also
that.
look at the Korean income as if it was the same as the American income.
Correct. Once you're past this 10 years, correct. Okay, so that's well, you can go now. I think, there's 25 minutes before the Bear game, so we still have some time. But this is just my contact information or the office. I'll try to do something I know last year's presentation I put up, we put online, Liat, I don't know what the link is, but it's on our website.
Yeah.
And if you need to, there's a lot of information, it's about to come out in a new version. Our office number is 0264444000. Contact Michelle at P. Stein with any follow-up questions, or if you want to meet any of our staff. And that's my general introduction. I think I'm going to now go to, as I said before, when we originally envisioned this presentation, there were 3 of us here, but because it's so close to the Chagim, so I'm covering. So now it's still me, but this is one of my colleagues. This is a presentation from a very close colleague of mine. He's attorney Yair Binyamini. Judah, I assume I can speak in the name of an attorney, even though I'm an accountant. Is that violate the rules? Okay. But I'm giving him total credit here. So I'm going to touch, if there's anything I've already touched upon, but he put a little focus on some things perhaps you can do. This is probably one of the key questions, and I think someone walked in before. When did you really start becoming a resident? Okay, in other words, is it when you took out your Tudat Oleh? Maybe you took your Tudat Oleh, went back to finish up things in the States, and then came back later. Did you take a break? In other words, if there's any safek, if there's any doubt as to when you really, maybe you first came as a tourist, and then you only change your status later on. We've had people who came initially on on student visas, and then changed their status. People who changed their status, went back to the States, then they came with their families. So this is very important, because that tenure is very, very, very valuable, and obviously you want to know when the clock starts ticking. So these are things that you really need to do. If there is a doubt, if there's any safek, if you think there's some wiggle room, we highly recommend you getting an opinion from an attorney like Yair. And he'll ask questions about where was your home and where was your family at the time, when did you make Aliyah, where were your economic interests. Some of this overlaps internal U.S. law, internal Israeli law, the treaty. There's a lot of factors that come into play here, but this could be very valuable. You might buy another year or two or more on the 10-year exemption. So I think that's the first question. If you think, well, my 10 years is up, maybe it is, but maybe it isn't. And if you have any doubt, it's worth looking into. Again, this is just an example that he had put up here in terms of what a wife and minor children moved to Israel for a school year in September 2008. They lived in a rental apartment. The wife was teaching at Tel Aviv University for the sabbatical year. The family retained their U.S. home. The husband continued to work in the U.S., visiting the family on travel. They sell their U.S. home a year later. They purchase an Israeli residence in 2010, and they only make formal aliyah in 2011. The husband keeps commuting for work. The 18-year-old goes back to college. So when does these are not such an uncommon stories or scenarios. We see it, and the Israeli law is gray. The treaty doesn't give much clarity either. And really, if you can blend or tell your story in such a way, backed by a legal opinion, you may be able to take advantage. But this is just a small example of something you say, well, they really came in 2008. Well, maybe they came in 2009. No, maybe they came in 2010. Maybe it's 2011, or maybe the husband never came. In other words, there have been some court precedents in Israel where one spouse is considered a resident from date one, and the other spouse is considered from a much later date. Yes.
Suppose you become a citizen in the middle of a year, let's say July 1st,
Yes.
some year. So 10 years later, let's say it's July 17th. What do you do about this last year?
You would, in other words, in this example, July 1st, the first 6 months of the year, you would be under the 10-year exemption, and the last 6 months you'd be under the...
So you have to file twice.
And if you know that, and you know that that's a critical date, maybe you accelerate income before the date your 10-year expires, so that
Accelerate what?
accelerate some income, if it's income that you can have some control about, if it's something that a payment you were expecting, if you want to sell an asset, those are things that you might want to look, but it goes according to the day, to the 10 years to the day. It's not, by calendar year necessarily.
So for that 10th year, you're filing two sets of income tax.
No, you're basically filing one Israeli return, but you're only obligated to report and pay for the last half of the year. Yes.
So I understand correctly that we made Aliyah in 2008, but then we're not really here full time until 2010. That's possible that the 10-year might be.
Correct. Yes, absolutely. Absolutely. Yeah. You don't. There's a myriad of factors. There's a myriad of facts, and you may get an opinion to the negative, but you might get an opinion to the positive, and I think it's always worth looking into. Again, the exemption, as I mentioned before, this is more lawyerly in terms of it's for a new olim when you came as oleh. If you're a returning resident today, as opposed to when the law originally was written, you have to be out of the country 10 years. And Israel takes this very seriously. The 10-year rule, it's really 120 months. And if someone is a returning resident on the other side of the coin, and there's some doubt, was I really out 10 years? Maybe I visited a lot during the 10 years. My family back in Israel. Maybe my kid came back a lot. I also highly recommend getting an opinion there. Again, now we're looking through Israelized. When I call foreign source, you have your business back in the States, personal services, which I refer to, interest, dividends, royalties, rental. This is really things that I refer to in terms of who gets the first bite. Now, potential issues, and this is something I think people have to be aware of. When the 10-year period, during the 10-year period, not only were you exempt from paying tax, but you didn't have to tell them anything. You didn't have to report anything to them. On a few occasions, the Knesset or the Treasury actually tried to change. There's sometimes rumors floating around. People have come to me, did you hear? They're trying to get rid of the 10-year exemption. Since 2007, 2008, since this law was passed, there's never been an attempt by the Treasury to cancel this exemption. What they've tried on 2 or 3 occasions was to cancel the exemption from reporting. They want to know what people are earning even under this period of exemption, and I think fortunately Nefesh B'Nefesh was able to lobby and pushed it back 2 or 3 times. But at one point you are going to sort of come out of the shadows, and you're going to come into the light, and there are some potential issues. In other words, you may file your first tax return, and they may say, wait a second, this salary, which you never told us about, and we see according to your passport that you spend 90% of your time in Israel, that didn't fall under the exemption. In other words, when you were working those 90% of the year in Israel, even though from a U.S. employer, you really should have been paying tax. So the fact that tenure is over, there is what I call here, or Yair said, some audit risk that maybe in year 1 or 2 of you filing, that some tax inspector may want to look back and say, wait a second, you didn't have to tell us about it back then, but now we're interested, and because you never filed, there's no statute of limitations, if you know what that means, meaning there's no time prohibition from Israel to go back all the way back 10 years. There might be some problems with double taxation. You paid tax, and now suddenly Israel's coming along. That is pretty much mitigated because there's a special rule in the U.S. that says if a foreign authority taxes you as far back as 10 years, you can amend your returns as much as 10 years back. But again, the example I'm giving you, it's now year 12, it's now year 13. Well, if they go back to year 1 and 2 and 3, that statute may be closed. One thing that we came across, I think this was about 2 years ago, people who were not under the 10-year exemption, who were going back to work in the U.S., suddenly started getting letters from Bituach Leumi. And they were reporting, they were paying to the Mas הכנסה, the Israel income tax, on that income that they were earning in the States. And Bituach Leumi came along and said, we never signed it. That law was for income tax. That wasn't for us. And I happen to know the guy who drafted the law, and I called him up, and he said, they're right. My intent was to include Bituach Leumi, but the fact is it wasn't in the legislation itself. Bituach Leumi actually went to several meetings there. They were actually very understanding. They're trying to find some way that they don't really kill people with going back many years on Bituach Leumi, but just be aware, again, once you come out and you start reporting, Bituach Leumi may be something that you're also going to be subject to. And of course, you have all these new reporting obligations, and you have to tell the tax authorities about companies you own. It's for informational purposes and not just the income, even if that company you may not be taking a dividend or what have you. Again, this is a bit technical, but in terms of what Yair feels are planning opportunities, see if you can move your date of residence when you became a resident as far forward as possible. As I mentioned before, capital gains, just don't worry. It's not like you're going to pay tax the minute you pass the 10-year period, because you have 10 years of zero tax. So even when you get, we're particularly talking about U.S. real estate, if you sell it in year 20 and half of that gain is not taxable, and the tax rate is 25%, 50% of 25% is 12.5%. So even if in year 20, year 25, you could sell real estate, you could sell a business, you could sell other assets that were in the U.S., you won't pay any additional tax.
Is that stocks also?
Stocks, if you've been holding stocks a long time, absolutely. And then there's some other techniques in terms of declaring a dividend if you have a company, and then loaning the money back, and then getting loans, generating debt, creating a sale of an asset, an LLC, to create a capital gain just before your exemption period. This is really if you have something more sophisticated to do, if you have assets that you have a lot of control over, particularly business interests, and there are some things that can be done. Again, yes?
On the capital gain, is it prorated by year? In other words, you had a stock 10 years, then the 11th period, you held on to it, you've been in Israel all that time.
Yes.
And you sold in the 11th year,
Right.
at the end of the 11th year. what if you demonstrate that all of your capital gain is attributable to the first 10 years? It's going down after that.
I'll tell you, what if it was just the last year? What if you had a company that was a dog, and then suddenly in year 11,
Yeah.
it went, you've been holding on for 11 years. Israel will just say 1/11 of that gain is subject to tax. So it can be to your benefit or to your detriment. But again, you get into numbers that they're gonna, your Israeli tax is still gonna be well below your U.S. tax in that instance. Again, some other things to be aware of. You have a business in the States. There's a concept in Israel called management and control that gives Israel potentially the right to tax businesses that are not in Israel. Yair's opinion is that if it's a real U.S. entity, the treaty doesn't allow Israel to tax the company. They'll allow you to tax a dividend if you take money out. They'll allow you to tax a salary if you take a salary, but they won't allow you. The treaty, he feels, won't allow you to tax the entity. If you are a beneficiary of a trust, there are some decisions you need to make. Again, when the 10 years are up, what path you take is a bit complicated. And if you funded a trust, it may not make sense to have that trust anymore because of Israeli tax consequences. That's something, if you are a beneficiary, or if you are a trust, or if you're a trustee of a trust and you're past the 10 years, you should consult with an Israeli tax consultant. And then, of course, something I was referring to before about reporting and credits and who gets the first cut. And that is the name of Yair Binyamini. He can be contacted at Yair at benjamini-law.com. Please tell him that I recommended you. He's located in Tel Aviv, but he does come to Yerushalayim, and he's very creative, and I think you would find him very helpful if you feel you have issues that really need an attorney. Okay, and the last, yes.
So if you have the choice of creating an entity in Israel or the U.S., you're saying Israel won't tax the entity itself if it's created as a U.S. entity?
If it's a U.S. entity, and he's not the only attorney I work with, they feel that the treaty gives you protection. In other words, the place where people are most vulnerable, if you told me, and I'm not referring to you as you, but if you said to me, well, you know what, I plan my tax affairs very wisely, and before I came to Israel, I set up a BVI, a company in the British Virgin Islands, or I set up a company in Luxembourg or Cyprus, which is perceived either as a low tax jurisdiction or a tax haven. In that, Israel would be able to say, the day you enter 10-year exemption, that company, we're going to tax it because you own it, you run it. Yes, if your company, you pay tax there, it has a treaty with the U.S., defines who is a resident. Israel can't tax someone who's not their resident, and it says a U.S. corporation is a U.S. resident. Okay.
Well, I live here, but I have an address here in the project, so you can LLC.
Israel views LLCs by default as companies. They don't view them as transparent entities. You can elect to treat it as a transparent entity, but again, quoting Yair, his opinion is you can use the treaty for protection of Israel being able to tax that entity. Okay, so the last thing is, this is another colleague of mine. The firm is called Stark & Stark, Iris Stark, who's a very well-known Israeli accountant. Their office actually is in Ra'anana, and she was on the panel with me when we did this presentation first. She also wasn't available tonight, so I'm just going to go through again. Some things we've already touched upon, and some things aren't so germane to this discussion, but just to give you a little bit, these are things, of course, that we know about, or I've talked about. I think here, one of the things that you should be aware of, or a couple things to be aware of on this list, there is no estate tax in Israel. There's no gift tax in Israel. Okay, it doesn't appear that there is going to be any. You may have a will, you may have an estate there, a trust for estate tax purposes. Israel will respect that. Israel, just again, if you're going to become now an Israeli taxpayer with regard to charity or tzedakah, Israel will give you a 35, no matter what bracket you're in, they'll give you a 35% tax credit. I think tzedakah is any deduction, I think over 400 or 500 shekels, something like that. So if you suddenly are having to pay tax in Israel, you may want to shift your tzedakah to Israel and give to Israeli charities. If you are going to give to Israeli charities, make sure that the receipt, the Kabbalah, says that this is eligible under Section 46. That's in the U.S., the equivalent is like a 501c3 organization. In Israel, it's called a Sif 46. That is a legitimate receipt, which you can go to the tax authorities and you file a return original. You have to hold on to the original receipts to get the credit, but it can be very valuable and reduce some of the bite of your U.S. tax. They'll also give you a credit for contributions to U.S. recognized charities, assuming you still have income in the U.S. Yes?
Does that receipt have to be paper or can it be electronic?
I think it has to be. It's still old-fashioned here. If it's not paper, then it has to be a copy with them stamped. I think Ne'aman Lamakor, it has some, chotemet on it, something like that.
I'm pretty sure for this category it has to be paper.
What?
There are electronic receipts in Israel, but for charity it has to be.
I've seen in my own filings, I've always had to present original receipts. And again, if anyone feels that they may have not done something correctly, Israel, they had some programs before for voluntary disclosure. Those official programs closed at the end of last year, but you can still have an Israeli accountant or lawyer shepherd you through, start the process anonymously, and clean up your act, so to speak, before you sort of come out into the light. I'm not going to go through that. All right, this is just some general information all of you should have. Israel, the corporate tax this year is 24%. It's actually going down next year to 23%. Capital gains and dividends in a corporate, I'm not going to relate that. But on the individual, the highest bracket goes up to 48%. There's also something called Mas Yesef in Israel, which can add another 3%. But again, that's the top bracket. It's not, I'll show you the brackets in a moment. On capital gains, for most of you, it would be 25%. If you own a company, 10% or more of that company, and you sell it, you can be subject to 30% or 33%. Dividends, again, unless you're what's called a Baal Shlita, meaning you own at least 10%, it's 25%. VAT, all of you are familiar with that, that's 17%. I'm not going to payments to foreign residents because it's irrelevant. That's just taking a look at individual tax brackets. Again, this is not for investment income. This is if you're working or you have rental income and you don't choose as I said, the maslul, the path where you pay a fixed 15% based on rent less depreciation. This is just, again, brackets. So yes, there is a 48% bracket, but it takes quite a while till you get up there. Only till you get to that bracket. So those are the brackets, and again, they're certainly steeper than the U.S., but they do exist. Bituach Leumi, Social Security, which you might say to if you're working here, these are the percentages. The employer pays, the employee pays. If you're a very low wage earner or you're taking some part-time job, you'll pay very little money. If you're earning above 5,678 shekel, up to 43,000, which is the max that it's the ceiling for payments to Bituach Leumi. Those are the percentages you'll pay. In Israel, they also, on wages, you pay a health tax, mas briyut. That's only paid by the employee. And those are some of the totals, and particularly if you're still working. Again, we've gone through who is an Israeli resident. Again, there's been some court rulings that allowed people to split their residency. I mentioned before about taxation for people out, or your rental income outside of Israel. In Israel, if you have some investment property, rental income, you can choose, and most people today do it. You just pay a flat 10% on the rental income without taking into account any expenses. If your rental income for that property is less than 5,030 shekel, which is approximately $15,600 per year, although the exchange rate has changed, it's probably even more than that today, you pay zero tax to Israel. So if you buy a small apartment, you rent it out, you get 5,000 shekel a month, you pay Israel zero tax. If you earn 6,000 or 7,000, you can choose to pay them 10% of the flat. You don't even have to file a return. You pay it once a year on a voucher. And again, if you want to pay based on a net basis, if you look at number 3, you don't start at zero rental income, you start at 31% tax bracket, and that applies also to income you're getting from the U.S. But you can deduct all your expenses, including depreciation. So if someone says, well, I'll just start at zero on my rental income, that doesn't work that way. You're going to start at 31%, again, after all of your expenses. There are other taxes. One of the big changes in the recent year is that Israel had a blanket exemption on selling your primary residence. No matter how much money you earned, you didn't pay tax. From 214 and onward, if your apartment, you sell it for more than 4,456,000 shekel, the first, up till that, the gain is exempt. Anything above that is chayav at the 25% bracket. This comes into play sometimes of clients of mine who have been living here many years, who bought an apartment in the German colony or Talbia in the 70s, and something that they paid $40,000 is now $2 million. So the U.S. says, well, if it's your primary residence, you won't have to pay tax on it on the first $500,000 gain, but they're way above that. And Israel won't tax you very much because also they have a linear approach. So you end up having to pay Uncle Sam quite a bit of tax on something that Israel's starting to get into the game where they're taxing it. Yes.
If we could go back to capital gains,
Yeah.
dividends, and interest.
Yeah.
If that's all your income, does it start at zero?
No, it doesn't.
So you would have to pay 25% if you
Right.
have $10,000 in capital gains.
Right.
You get to offset capital losses
Yes, sure.
in Israel. So it's a net number,
It's a net number.
but it starts from zero to, let's say you only made $1,000.
You'll pay
You'd have to pay
25%. Yeah.
$250.
That's why I say you may want to
And
shift
dividends
your
also.
yes, you may
you'd have
want to
pay-
shift your tzedakah here to counter that. You will get some what is it called? Nikudot zikui here. In other words, there will be something to lessen it, but the tax calc is going to be at 25%. There's no marching through the brackets.
Are there exemptions in Israel?
There are. You get a little bit. It's more based on. It's a more of a tax credit, but it's really a few hundred shekel. It's not so significant. The biggest thing that Israel gives the individual is for charity. Period. Charity for tzedakah. Yeah.
On capital losses that you can deduct against gains, is that a?
You can't. Israel won't let you take a capital loss in the U.S. against a capital gain in Israel, or vice versa. It has to be in the same country.
What about a capital loss carried forward from the
No.
U.S. to the U.S.?
No, because they'll say those losses, those capital loss carry forwards were during a period that you didn't have to pay us tax. We're not going to let you take advantage of it.
Wait a minute, could you say that again?
In other words, if someone becomes obligated to pay tax in Israel in 2018,
Right.
and on their U.S. tax return that in 2018 they had $10,000 of capital gains, but they say, I don't owe anything to the U.S. because I have 10,000 carry forward losses. Israel would say, Forget the losses. We're gonna only look at the gains.
So a capital loss carryovers are,
Are not
You're only allowed $3,000 a year.
No,
no, if
that's
it's,
something
if it's
different.
against capital gains, there's no limitation. That's only capital losses. 3,000 limitation is against other losses. If you have no capital gains, they'll let the U.S. Israel doesn't have such a rule.
so we can't take our capital loss carryovers?
Right, so that
Not
would,
the
that,
3,000
no, so
either?
that would be a consideration. You say, wait a second, I've got this big amount of capital loss carry forwards. Israel isn't going to recognize it. Wow, I should actually take some capital gains before my exemption period expires to take advantage of that.
This is in case you sell your property, right?
Of course, yeah. You're only taxed if you sell. Again, we talked about new immigrants, adjustment year. That's where people would be sitting here who just got off the Nefesh B'Nefesh flight. I'm not going to talk about that. We've covered very much what the benefits are during the 2 years, the 10 years. This is an interesting thing you should be aware of. That, and it's not related to the 10-year, but we have clients all the time who inherit property. They've been living here. Now in the U.S., the rule is when you inherit something, your tax basis is the value at the date of death of the deceased person. So it may have gone up a piece of real estate in New York. A parent may have bought it for $50,000, and it's on the Upper West Side of New York, and now it's worth $5 million. And I've seen that. I've seen that recently. Apartments on Central Park West, that can happen. So Israel says, well, we don't have a rule. We don't have a step-up basis rule. But if Israel said a few years ago, if you inherit property that was from someone who lived abroad and you come to us, we'll grant you that step-up. So you won't have to pay tax in Israel on that, and not having to pay tax in the U.S. on that. Is that clear? So if you inherit money, you should assume, or assets, that a lot of gain was forgiven because
You just
the
said
person
there's no
died.
estate tax in Israel.
What?
You just said there's no estate.
It's not estate, I'm talking income tax. That example I gave. Someone in the 70s bought an apartment in Central Park West for $50,000. Today it's worth $5 million. The person who bought it died, and their son or daughter inherited. If they sell it the next day, it's considered they bought it for paid $5 million for the asset. So there's no gain, there's no income tax to pay. We're not talking estate. Israel says you have to pay us the gain unless you come to us first and ask for that stepped-up basis to be in the same treatment as the U.S. It just means it seems silly because they just give it automatic, but you do have to apply for it. Again, as I mentioned before about tzedakah, you get a 35% credit. There is a limit. You can only give up to 9.2 million shekel, but I don't think that's going to be a problem in any one year. Trusts, I mentioned before, and as I mentioned also, there's a voluntary disclosure. There's no formal program, but people can shepherd you through that process. The pensions we covered, and I covered 3 speeches in a little over an hour. So at this point, again, restart. I don't know if she gives herself. No, I don't see.
It was on the first page.
It was on the first page. So if anyone needs a good Israeli accountant, want to give her
You mean like?
CPA.
There you go.
They are based in Ranana, but they're English speakers, and they can.
You
be
do
very
Israeli
helpful.
tax returns?
No, our firm does not. We work with a lot of firms. That we have one sitting right next to us, so we can work with any Israeli accountant, or we can recommend an Israeli accountant.
But you don't do
We do not do. We do. We know the rules. We can build you a plan. We coordinate. We quarterback very often.
You can recommend them.
I quarterback or my staff does, in terms of who should pay who, come up with tax planning, but we don't fill out the forms as
So what do you do, American taxes?
We do American and help you navigate between the two systems. Okay, so I'll take a few questions, yes.
our 10-year exemption is up. We have a pretty standard income spread. Pension, interest, dividends, capital gains, and a Schedule E. You've explained very clearly who gets the first bite of
Good.
what.
Okay.
But I cannot see, I have to file 2 tax returns.
That's correct.
What gets filed first? How is it done? What's the mechanism of filing these 2 returns?
Hello, you want to answer? Generally, we do the U.S. goes first.
With what income?
With your total income, and the U.S. allows you to accrue tax, even if you haven't paid Israel yet, they'll let you accrue or take those as if you paid them in the year, take the credit, and then we tell the Israeli accountant how to divvy up the pie. So our approach is we prepare the return first, we organize all the material, we even have a worksheet which we give to the Israeli accounting firm to who gets the first bite, and that's how we work.
And then how do you get it back? What's the mechanism to get it back?
Get what back?
To get the money that if you're going to be overpaying.
No, we already coordinate with the Israeli accountant. Or again, as I said to that gentleman, if we know that the tax on dividends, interest, capital is 25%, we can take that as a credit even before it's paid.
So
On the
you're working
US
them both
return.
simultaneously?
There is some simultaneous, but the system works. If you gave a lot of charity, we take that into account. Sometimes we fine tune. Maybe we were a little off, and then the following year we catch up and fine tune.
Because, I mean, dividend seems to be okay, but interest
Interest is also 25. But again,
interest has to be paid to Israel first, but it also has to be paid to the U.S.
first, yes, that's why we do what it's accrue the tax. We accrue the tax. But these are technicalities. I assure you, for the last 14 years, we have developed a system. I'm not the only one. It works. So as you can...
You accrue the tax?
Yes, you accrue the tax before you pay it.
Phil, can you
Is there a credit involved in
Yes.
this? What kind of credit?
Tax credit.
What kind of tax credit?
If
There has to
you-
be a name to this credit.
It's called the foreign tax credit.
Okay. How can you apply a foreign tax credit to my tax return?
Because I know that Israel's going to charge you now 25% on your interest.
The
So
foreign,
I can take that into account when I do your U.S. return, even though you're only going to pay it a month later to Israel.
okay, but the foreign tax credit requires that a person have foreign source income in
No,
order.
it doesn't. You missed a couple slides. It said interest in the U.S. bank, Israel gets the first bite. Capital gains in the U.S., Israel gets the first bite.
And that's considered foreign,
Yes, under the treaty.
and that's enough to give back everything that I paid?
It depends. Again, this isn't a specific consult tonight, but I'm telling you, it works. And if you need specific to see your case, I guarantee you, you won't pay double tax. You won't pay double tax.
Phil, you made a general statement
Yes.
after the 10-year exemption,
Yes.
the individual will end up paying more taxes.
It's not
For the
foreign
most
source
part.
income.
For the most
Nobody's
For the
calling
most
it
part.
foreign
For
source
the
income.
most part.
You really made my day.
Sorry. You're helping the state of Israel. If that makes you feel any better. What, huh? Well, if you give Liat your contact information, I don't know exactly how we're sharing, and I have to talk to my
This is
colleagues.
going to be on Facebook, this whole seminar.
Yeah, so there is going to be, there is a record of these slides in a previous, online, at our website, so, yeah.
Israel gets quite an interesting color we discussed,
Right.
but sucker that we give is deducted from that.
It's not deducted. Israel, as I said, gives a credit. So if you give 10,000 shekel or $2,500 of tzedakah, you'll get a 3,500 shekel tax credit. So if you have paid on 10,000 or $5,000 of dividends in the U.S. And they're now charging you $1,250. You can take that Deduct a tax credit to reduce your tax.
Yeah, we came from the UK, so we're not concerned about US treaties.
Another country I know nothing.
And you mentioned tax havens. Shortly after we made LER, we went offshore to the Isle of Man.
Yes.
We paid no tax anywhere.
One of the
Am I
privileges.
now going to lose that exemption?
Yes, of course. Yeah, that's one of the benefits Europeans have or Canadians have, that they did not have to pay tax to any place during that 10-year. It was a big benefit. So for the Americans, it's going to be, this gentleman said, am I going to pay more tax? Yes. Are you going to pay more tax? Hell yes.
You mentioned consulting income as a separate category.
Yes.
But I'm confused on, there's three ways you can have consulting income. I can have it as an employee who's a consultant. So
As a what?
I'm an employee, so that's your profession.
That's your salary.
That's your salary.
Yeah.
So then, you could be an independent consultant.
Correct.
And then you have a consulting company.
Yes.
So in my case, I have two consulting companies, one in the US, one in Israel. I have employees. So is just the salary that I pay myself in each company? So where's this consulting?
Well, first of all, you have an Israeli company.
An Israeli company, no, an
Then
employee.
you've been paying tax, and you've been paying tax on your corporate profits,
Right.
and on your U.S. company. Again, according to my legal colleagues, only money take out in the form of salary or dividend will you be subject to tax. You'll have to report the
In
existence.
each case, is their salary. So where's the consulting part?
Well, when I mention about consulting, is someone who does not have employee status. Just says I'm a.
It's like an oxymoron.
It's not money.
Okay.
Right. Yes.
The foreign tax credit on the U.S. return is only for the income part of it, it's also Social Security and the Medicare part?
No, it's only for income tax.
Okay, so you still have to pay Social Security and Medicare in the U.S.?
Yes, there is no treaty. The treaty that came into effect in 1995 between Israel and Israel was an income tax treaty. There is something else called a totalization agreement that countries, almost every normal country, Western country, throw in Japan, Australia, New Zealand, they have a treaty with the U.S. that prevents double taxation of Social Security, and let's say Bitul Hukumi. In our case, there is no such treaty with Israel, and there won't be. Yes, sir.
So if you have a capital gain and you're still within 10 years in the United States, Israel gets no part of that.
Correct.
But if you have a capital gain and a capital loss together in the United States after the 10 years, you're saying that they don't give you credit for capital?
No, they'll recognize the capital loss if you take it in that year that you were no longer exempt. What this lady was referring to is you've got a big capital loss carry forward that was from periods either you were before you even came or during the 10-year. They're not going to let you offset capital gains against it. But as I said before, for the most part, if it's capital gains, something you've been holding a long time, it's going to take many years till Israel gets a piece of that.
What about the 10 years?
Or, I shouldn't say that, Israel get a piece, but before you're feeling any increase in your tax. It'll just be al khashbon the U.S. government. Because you may be paying 4%, 5%, 8%, but if your U.S. is 15 or 20, then you're neutral. Because you'll pay 8 to Israel and 12 to the U.S. So it'll be very many years before your effective Israeli tax rate exceeds your U.S. tax rate on the real long-term capital gains, on things you've held for a real long time.
What if a U.S. Investment is held through an Israeli bank, even though it's held with an American financial institution?
If a U.S. stock is held through an Israeli bank, Israel's going to withhold 25% because you held it here in Israel. In other words, that never fell under the 10-year exemption. Because if you buy Apple stock in an Israeli bank, and you sell it, the bank is going to withhold 25% on the
If the accounts were just transferred over here as custodian to make the Israeli bank the custodian, but you already own the
You probably have to get a. You'd have to go to get a ptor from Mas Akhnasa, explain the history of the investment, and get them to take a reduced withholding at source when you sold it. Okay? I'll take 2 more questions and then that's it. Yes.
What about your capital loss carryovers during your 10-year exclusion? Do you get any benefit from those?
No, they weren't taxable, so the losses. Last one. Okay, thank you very much.
Thank you.
Roll 'em out. Roll 'em out.